Good morning, options traders. Well, I wanted to take a little different tack for this video, although it does contain a lot of the same messages that I put throughout. But I want to talk specifically about randomness, and in particular, being careful with predictions or following those who claim to be able to make predictions about the market. And the reason I'm doing this is that in our group, we're starting to get a lot of comments where people are saying, what do you think about this newsletter or about this service? Seems to have a good track record. And you find these kinds of behaviors during market panics like we're in right now with coronavirus. And people want a helping hand. I need some help with my trade, so let me find somebody who can make predictions. The problem with this is that you have to be very careful because of randomness. And randomness can produce beautiful patterns, completely different from things that you would ever expect. And that's probably the main message of this presentation. So let me give you a couple of examples and to show you why it can be so deceptive. So here is an Excel spreadsheet that I created, just a screenshot from it. And what I did is I basically did a digital coin flip from 0 to 1. And if it comes up a 1, the box is colored in red. And if it comes up a 0, it's colored in white. So we look at this and we go, okay, that's kind of a random pattern. I don't really see anything in there. But the reason is it's not really overlaid against anything. We don't have a formal backdrop. So what do I mean by that? Well, what if we put a map of the US over it? Now we start seeing patterns. And we say, let's say that it was maybe an epidemic that broke out, or maybe the corona pandemic. And we're looking at these and we're saying, oh, look, it's only in the major cities. I can see that. Or it tends to be more in the south and in the north, or it tends to be more here than there because we can see it. And our eyes always want to try to make stories to fit the data. That's just how humans are wired. We're always looking for patterns. And it's very easy to make a theory that fits the patterns. But here's where it gets even more difficult. What if, before I put the map of the US over it, what if I had zoomed in and I put it on a different scale? So maybe we would get this. It's still completely random, but now we might say, oh, look, it's mostly out west and maybe in the north, but the southeast seems to be pretty free of it. Must be something going on in the southeast. What are they doing differently down here? Let's investigate that. Or they might say, isn't it strange that right here along the panhandle in Florida, they got hit with it? Oh, it must be the Apalachicola Bay right here. That's what's causing it. Really? Well, why isn't it the capital, Tallahassee, or Pensacola, or Destin? A lot of different things that could be up here that could explain it, but we go, oh, that wouldn't be any rational reason. It's got to be the Apalachicola Bay. It's got to be the warm waters up here. Oh, and look it up here in Maine. Oh, it must be the lighthouse up here that's causing it. Because isn't it weird how it just got stuck in this one little part? Obviously, something is going on here. Well, it's not obvious. It's just noise at work. So you have to be careful whenever you're looking at data that it can't only be consistent with your theory. It has to be consistent with the negation of the theory. What happens if you didn't do this? So I talked about in a previous video, if I go out and I do a rain dance for 30 days and it creates rain, I shouldn't say I caused the rain. What about the negation of that? What would happen, or what would have happened had I not done the rain dance? Well, it still would have rained. See, it's got to be consistent on both fronts. And yet you're going to find that most people don't do it, especially if they're not formally trained to do this and they just go out and use their eyes to look for patterns. So how does this happen in the stock market? Well, let's take a look at some stock charts. So we take a look at these charts and we might say, well, obviously something very powerful happened through here, maybe a big earnings report, maybe a bad earnings report right here. I can see this is a level of resistance up here. Look at that, almost to the penny right there, resistance. I can see right here is probably a bad earnings report, some kind of a big news event happened. It's very obvious because my eyes can see it. And look back here, look at this resistance, resistance, resistance. And then we got strong support down here, followed by some big news event and up to a new level of resistance. See, stocks move in waves. They come up, they move sideways, they go up to new levels. I can see it. And people start making their theories based on that because it fits the picture. Well, now here's the surprise. Out of all four of these charts, this one right here is Microsoft. It's the only real graph on the screen right here. The other three are fakes. They were created by coin flips. So again, it just shows that you can get unbelievable patterns in randomness. And if you're not used to this concept, it's very easy to look at these and say, well, they can't possibly be random. Something is going on. But they are nothing but noise. There's another principle at work that can help to explain some of the unbelievable predictions that people do, and that is what's called the Pigeonhole Principle. And what it says is, let's say if you've got some kind of a breeding box here, let's say we have 4 different little cubes, but we have 5 pigeons. Well, we know that there must be at least 2 pigeons in one of those boxes. Now that seems pretty obvious that we shouldn't have to name a principle after it, but it can be incredibly powerful when we're looking at much bigger scale problems that might seem to otherwise not be solvable. So for example, are there 2 people on the planet who have exactly the same number of hairs on their head? People say, that couldn't possibly be true. Well, think about the maximum number of hairs that somebody could have. And you could go through and do a scientific study. What's the densest number per square inch? How big is the surface area of an average head? Multiply it by 2, multiply it by 10. Doesn't matter. You're going to come up with a very big number that would be the absolute most possible number of hairs that somebody could have. And you're going to find that that number is smaller than the number of people on Earth. And so by the Pigeonhole Principle, you can immediately determine that there absolutely must be at least 2 people who have exactly the same number of hairs on their head. So how does this apply to the stock market? Well, let's take a look at the Dow Jones. Let's say it's roughly about 25,000 right now. And in any given year, a big year up or down would be about 20%. So let's say the maximum would be somewhere around 30,000, lowest would be somewhere around 20,000. So what's the range here? Well, we're looking at about a 10,000 range. So just looking at whole numbers, not counting all the little decimals that could happen, but we're looking at about 10,000 numbers that could occur. So think about how many people are in the stock market. Think of how many newsletters, books, journals, magazines, websites, TV channels. How many people are taking shots at the Dow Jones? Far more than 10,000. Somebody's going to get it right. It shouldn't surprise you, but yet it does. People say, well, this person predicted it. Think back to your Pigeonhole Principle. Not surprising in the least. So you have to understand that you shouldn't be impressed when something occurs out of a large number of possibilities. Somebody is going to guess it right. Now, a lot of you may not know this, but mutual funds actually use a similar tactic. They actually use what's called an incubation period. So what they'll do is they'll say, well, we want to try a new method. So we're going to put it on trial here. So maybe we're looking for the highest dividend paying stocks or the ones with mid-cap sizes. There's some type of a method that we're just going to use for this particular fund. But what they don't do is just come out and put it to the market. They let it sit there and kind of cook for a little bit. Could be months, even years. And what happens is that they keep the ones that worked and they trash the ones that don't. And so what does this mean? You look at their brochures and you find, gee, this is incredible. All of their mutual funds have beaten the market. I'd better follow them. But what you're not seeing is how many times they didn't beat the market. You're not seeing how many failed. So this is kind of a specialized version of what's called the Texas Sharpshooter Fallacy. So let's say you're walking by and this guy shows you a picture of his work here. This is from super far off in the distance. And you go, man, this guy's amazing. I can see it. I can see the pattern. It's right there in a nice tight group. I want to follow this guy. He's unbelievable. My eyes can see it. I can see the pattern. But what you're not seeing is all of the times that he didn't hit it. So it turns out we have this drunk cowboy that sits on the side of the barn taking pot shots at the side of the barn. And this is what he has on the side of the barn. So what he does, he starts looking for patterns like the mutual fund company, and he says, look at this one over here. Let me draw a target around it, and that's what I'm going to show you. So again, you're not seeing all of the times that were missed. And it's always easy to reframe it to look like there's something special going on. So again, you have to be careful when you see headlines like this. The man who called Dow 20,000 says it could hit 40,000. Big deal. Lots of people called Dow 20,000. Now, don't get me wrong, I'm actually a big fan of Jeremy Siegel. I'm not knocking him, I'm just saying that you have to be careful when somebody makes a claim like this that suddenly they've got the crystal ball. Tons of people called the Dow at 20,000. Not surprising at all that somebody gets it right. Or take a look at this one. The man who predicted the 2008 financial crisis says somebody is going to predict it. Why? Every single year since the stock market has started, there have been extreme doomsday bears out there. It's been predicted every single year. So what happens? Well, they don't show us all of the times and the months that they predicted it that it didn't work out. They just highlight the one time that it did. So again, Peter Schiff right here. Great guy, love his work, not knocking him. I'm just saying you have to be careful of the headlines like this and automatically assume that they know something that you couldn't possibly have done on your own. So this is why I tell traders you're far better off to learn how to hedge your positions, learn how to manage the risk, rather than spending your money for somebody to sell you noise. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.